quantitative easing. The quantitative easing is more inflationary than a quarter-point rate hike, which is really the only one that is on the table, even though they kind of bluffed 50 basis points a week or so ago. That seems completely out of the question. But even if they hike by 25 basis points, so what? What they're doing with their balance sheet, it will more than offset that. But why would the Fed even hike 25 basis points? To me, given that they've gone back to quantitative easing, it doesn't make any sense that they would tighten while they're easing. At a minimum, I think they will pause where they are. Now, in theory, they could cut, but I think that would be too much of a shock for the markets. The Fed typically doesn't do that. I mean, I wouldn't completely rule it out, but that is not how they've behaved. But I think what they will be able to do is justify nothing. Most people still expect the Fed to hike 25 basis points. But to me, again, that makes no sense given that they've already started QE. Plus, if they raise interest rates, they will put more downward pressure on longer-term bonds and mortgage-backed securities, the very ones that the banks are loaded up with and that they're now swapping with the Federal Reserve. So if the Fed hikes rates, it's going to worsen the banking crisis that already exists and force it to do even more QE. So why would it want to do that? I think the Fed would want to stop that, to not put any additional pressure on a situation that already has a lot of pressure. So it makes more sense to me that the Fed will come back and say, we're pausing given all this data. After all, we said we were data dependent, and we are. They could point to the big drop in oil prices and say, hey, that shows that inflationary pressures are easing. They can talk about the impact that the banking failures could have on the economy and consumer confidence. So there's a lot of data that they can point to try to save face and not hike rates. I think the risk that the Fed takes, if they in fact hike rates, is what if things get a lot worse and then they have to cut them? Because the bond market is already pricing in cuts, by the summer. So why would the Fed hike rates 25 basis points and then turn around and cut them by 50 basis points or 75 basis points? Wouldn't they look really foolish if they put in one more hike and then went from a hike to a cut? I think they would save face somewhat, although they shouldn't be saving anything. I mean, they should have no credibility. But I think it makes more sense for the Fed to go to a pause before a cut than to go hike and cut, because hike and then cut makes them look even more incompetent. At least if they pause and then cut, they can say, see, we did the right thing by pausing. But if they hike and then cut, well, then it's an admission that they never should have hiked in the first place, right? So to save that little bit of credibility, I think next week the Fed is going to do nothing, which amounts to another ease. They've already gone to quantitative easing from quantitative tightening, and they're about to go from hiking rates to a pause, which is another ease, and which is merely a prelude to a cut. So now the tightening cycle is over for the precise reasons I always said it would end. The Fed was going to tighten until they broke something, and they broke the banks, which is what I've been saying. I've been saying all along, there is no way the Fed can fight inflation without creating a financial crisis, and that's what they've done. And if they keep fighting inflation, this financial crisis will be much worse than 2008, and nobody can be bailed out, because you can't have bailouts and an inflation fight at the same time, because the bailouts are paid for by creating inflation. They have to expand the balance sheet to bail anybody out, because the government doesn't have any money. The government is broke. The government is running massive deficits, and in fact, the Fed is broke. The Fed is losing money. So nobody can be bailed out without the creation of additional inflation. That's how I knew we were going to end up in the precise predicament that we're now in. The fact that so many other so-called experts couldn't see this, despite the fact that it was obvious, just shows you that they're not experts at all. They don't know what they're talking about. And the fact that we haven't had a crisis in the last 10 years isn't because these guys were right. It's because so many of them were wrong that we were able to kick the can down the road for as many years as we have. But there's no more road. There's no more can kicking. This is This is the real crash. This is what I've been forecasting and positioning my clients for over a decade. We're finally going to have to deal with the inflationary consequences of the monetary policy mistakes. We caught a break in a way, although the extra time just enabled us to make the problem worse. But we should have had a currency crisis and a runaway inflation a decade ago in response to QE1, QE2, but we didn't. The strong dollar that we got early on kind of gave us a reprieve. We were able to export a lot of our inflation. The stock market went up, the real estate market went up, and so we did all this quantitative easing, but we didn't have to pay the price. Now we're having to pay a much bigger price because we did much more quantitative easing. And one way to know that it's different is look what's happening to gold and the dollar. The dollar was down today. Gold was up today. In fact, the dollar has been somewhat lower. It hasn't crashed, but it hasn't taken off. It hasn't surged. But you go back to the early days of the 2008 financial crisis, the dollar was going ballistic. It immediately went straight up. Didn't happen this time. Gold started to sell off in the 08 financial crisis. Not this time. Gold is going in the other direction. So this is different. And there's two reasons for that. One, when the financial crisis started in 2008, gold was at 1,000. It had gone up from under 300 in 2001 to 1,000. So it had a huge move up. It was due for a correction. Everybody was long gold because it had this big run. The dollar index was down at near 70, all-time record low in the summer of 2008. So everybody was short the dollar. And so when the crisis happened, people covered those dollar shorts. They took profits on their gold. And so we had these moves. But now, fast forward 15 years to 2023, you don't have a lot of people long gold. Gold's had a 10-year consolidation. Gold is still below its peak from 2011. Silver is way below its peak. It got up to $50 an ounce in 2011. It's 20 now. So you don't have that situation. So people are more likely to rush into gold and silver than take profits on gold and silver. And where's the dollar index? It's above 100. It's around 104. It's nowhere near 70. So everybody owns the dollar. It's a crowded trade. So now it's going to be the reverse. It's going to be sell dollars, buy gold and silver. But also now we're going to get the inflation we should have got a decade ago, only worse, because look where we're starting. The Federal Reserve has not only ended its tightening cycle, it's already began an easing cycle. This is the new easing cycle. The balance sheet is going to explode to new highs. Soon it's going to be above 9 trillion. I think it'll end the year well above 10 trillion. We could be above 10 trillion by next month, right? So we're doing massive quantitative easing. We haven't had rate cuts yet, but there's certainly no more hikes, or at most one more tiny hike if we even get that, but I doubt we will, and we may get some cuts. So the Fed is starting an ease with year-over-year inflation at 6%.